anyone. So, a repetition, yin and yang of risk and resilience. Welcome everyone to part two. With me is friend, colleague, professional, fellow Anand, who's a champion on risk. Allow me to share my screen as well. I hope everyone can see my screen. We have kept time for questions, so please feel free to actually we request go live at that time, unmute and switch on your camera as well. Ask questions. We'll be happy to take any questions. But when we are speaking, please attempt to keep yourselves on mute. Discussions today is going to be, this afternoon is going to be, and afternoon according to India time, is going to be about force majeure clause, which I will pick up. But before me, I'll request Anand to discuss about risk and treatments available. One portion specifically today, he's going to focus on insurance side. So quickly about me, I'm not going to read all, but about 4 decades in the industry, 2 decades in BCM and resilience. I've played various roles. Being a practitioner, I have dirtied my hands myself and I have been trainer, consultant, auditor, assessor, author, speaker, 8 books published so far. I'm a winner of global national awards multiple times, into BCI Hall of Fame also. I'm a professor of practice with Chitkara University. With this, I'll request Anand to take over and continue, please.
Thank you, Daman. Very good afternoon again to all here. We do have a couple of new joiners and we do have a couple of people who joined us from the earlier session. So I'll just again give a brief intro about myself. So I've been primarily a corporate risk practitioner, now turned startup founder and CEO. We are a 15, 16 member company based out of Hyderabad in South India. And presently we have a risk management software. Daman and I have teamed up for, combining risk and resilience offerings. So we hope to have a resilience or a BCM uh, component also in our risk management software very soon. So with that background, I will just request Daman to move on. Thank you.
Thank you very much, Anand. Sorry. Yeah.
No issues. We are good. So essentially, today's discussion starts with how risks are managed in the company, and then ends up with, how force majeure could be used in multiple connotations, right? And how it could reconnect back with this entire practice of BCM that we're talking about, that Daman will cover a little later. But for the benefit of how that flow comes in and how we could, connect risk and to that extent resilience, I just thought let me start off with a couple of slides that talks about both risk responses and risk transfer options. And then from there, we could move down to Daman's area. So all of this may be basic, all of this may be 101 for several of us. But I think it's always good to pause once in a while and, retest the basics, revalidate the basics. All of us understand that any risks that company have, in the traditional sense that you develop a risk register, you also have a response strategy, right? And a response strategy can vary from traditionally the 4 that all of us know, which is avoid, manage, accept, and transfer. So each of these have a certain purpose. Each of these have a certain reason why they exist. I've thrown some examples there just to give you a context or a connotation of why, a response could like avoid be, right? For example. And each of these actually mean, are very tangible, I would say, ways in which companies have chosen to manage risks, right? The classic example for avoid is where MNCs have this policy-based decisions where they may say that certain risky geographies we really don't want to do business, right? A lot of MNCs choose not to go with risky geographies because they just don't want to get into any possible, implications of doing business there. It could be a highly political risk-driven, economy. It could be highly, volatile in terms of economics. It could be maybe a highly unsafe nation to work in or a highly corrupt nation to work in, say, for example, right? So by choice, companies choose to make these choices and say, we don't want to get there. And obviously, it denies them the potential benefits of doing business there, but it also very clearly ensures that they don't end up getting exposed to those risks, right? As against that, something like accept, say, for example, is a situation where you've exhausted all your cost benefit analysis. And the end result of that cost benefit analysis lets you understand that uh, working on this risk below this or beyond this really doesn't help us. So this term that is coined is called ALARP, which basically means as low as reasonably possible, right? And these as low as reasonably possible typically refers to risks which are in your control. So in many ways, they could be the same safety quality risk examples that I've given earlier on operational risks. But the idea is, in different ways you could look at it. You could say that's the green zone, right? For example, in a red, amber, green zone. Or it could be, a particular risk where, your metrics or your um, risk exposure limits are below a certain level, right? And stuff like that. So each company can define what that as low as reasonably possible means. And below that or beyond that, the company says we'll live with that, right? So that's basically what accept could, translate to as an example. Transfer, an area that we will cover in greater detail in the next slide. Transfers can happen in multiple ways. So you can have insurances, which is one way of risk transfer. You can have hedges, which is usually a synonym to insurance, but hedges specifically for commodity or foreign exchange or any of those financial risk exposures that we normally talk about, whether it is in an operating industry or in a financial industry, right? And apart from this, the one that really should kind of be exploited the most is transfer of risks via legal contracts. And transfers can be sharing, transfers can be the complete transfer of a particular, say, risk exposure, right? So these are the traditional ways. And then companies have started talking more and more, and as more and more jargon has come in, people have talked about exploiting this. People have talked, there are other combinations also of risk responses. But typically, what happens is in a situation where one company is competitively advantaged, right? It has a clear competitive advantage in dealing with one kind of risk, right? Those risks it could willingly take, right? It can willingly take those risks, but with the idea that there is superior returns behind taking those risks, right? So one such example that belongs to an industry that I am from is what we call as non-infringing IP positions. Now, all of us are aware that in pharma industry, you have this concept of an innovator drug and a generic drug, right? And typically, a generic drug goes off patent. I mean, an innovator drug goes off patent, and then the cheaper generic drugs can enter. But many times, what happens is if the pharma companies have this unique competency to be able to challenge the innovators, right? And so there's actually a legal battle, and then from the point of view of these challenging companies or challenger companies, essentially, if they lose that battle, then they could be paying damages in the millions of dollars, if not more, right? But they confidently fight the battle, and many times, more often than not, right? Sometimes 60, 70, 80% success rate for companies. They actually end up winning, which means that they are able to enter the market sooner than the others can, and they are able to charge a significantly higher price, right, for their product. So there are these very unique opportunities that may be available to specific companies in specific industries where a risk area could be a very significant competitive advantage. And in such cases, the word exploit is used as yet another option. So there are these available. And, what we will be doing, Damanji, if you can just, yeah, maybe just one quick nudge and then we can move forward to the next slide. We will do a deeper dive on this before we then, hand it over to Daman for today's topic. Please go ahead, Daman. So when it comes to risk transfer options, essentially, uh, there are multiple, opportunities available to make the transfer. The most common one that all of us know, and we kind of use it regularly and used it both in our personal and professional lives, is insurance. And there is this word called self-insure also that I've talked about, and I'll talk about that also in a minute. But essentially, insurance is available for any risk event where the risk is not deliberately assumed. So these could be acts of God, these could be fires, these could be any event where the company's property is damaged, or in certain cases a legal claim may come, like cyber, right? For example, and the company is unprepared for it, and basically ends up losing money, and then the insurance company steps in to support. Of course, there are this finer print where certain elements may be covered, may not be covered, certain circumstances may not be covered. There may be sub-limits for certain types of problems. But overall, the general understanding is that insurance is available for most of the risks where risks are not deliberately assumed. Now, what I mean by that is, let's say, for example, if I willingly go and, let's say, for example, the example that I took earlier, right? I'm exploiting certain risks. So I willingly go and challenge patents, and I get, sued. And then there are obviously damages paid. Now, that's a business risk. It is not an insurable businesses, but a non-insurable business. So sometimes those kind of elements might creep in, and in such cases, traditional insurance products or services are not helpful. Alternatively, I could choose to do what I call a self-insure, which basically means that instead of giving this insurance premium to a third-party insurance who takes the money away, and that money is gone the moment it takes it away, but I am insured for a certain, agreed sum insured. In this case, what I could do is I could choose to park this money aside, right? And it's not like keeping it in a fixed deposit or something, but it's actually setting up a captive insurance company and parking that money with that insurance company for a rainy day, right? So let's say if I'm trying to look at covering it for $10 million, right? And it's a business risk. Let's say it's the same IP risk that we talked about. Now, I may or may not traditionally give my insurance company a premium of 10 million for a cover of 10 million, right? I may probably give them a premium of say half a million or something. So when I set up a captive, or when I set up my self-insurance for the first time, I do need to have a corpus. That corpus needs to be available to be able to assume that minimum risk. And when I do self-insurance to what we call as a captive, there are certain rules of insurance that are also to be followed. But the advantage of setting up a captive is, let's say that over the period of the insurance premiums being paid, nothing happens, right? So that particular event, or that particular product, or that particular risk that you wanted to self-insure, that risk doesn't play out. The company has managed it well, right? Now, all the premium that is captured there, those premiums can actually be available to the company tomorrow, because the captive is its own subsidiary, right? But say, for example, if something happened, then to the extent that the money is available with that captive, the money can be used to pay off this, and anything extra obviously has to be borne in again by the parent company. So captives are very, very popular outside of India. In India, this concept, for unfortunate reasons, have not been permitted so far by RBI. But what companies are allowed to do, and I'm talking about non-financial companies, right? Financial companies can always set up insurance companies, but non-financial companies like the pharma company example I gave you, they cannot set up a captive insurance. So what they can do is they can probably plan to have a subsidiary which is outside of India, and that subsidiary, perhaps if it is a financial company, can then have its own captive or can set up a subsidiary that can have its captive. So a captive can exist even for ensuring business risks, for willingly taken business risks, apart from your regular risks that anyway insurance companies provide insurance for. Captives can cover those also, but otherwise captives can also help you provide for business risks, right? So that's something. And typically insurance, as we all know, covers both asset and liability. If it is asset, then essentially you know what is the damage value maximum that can be created. But if it is a liability, then there is no end to what that value can. So there is some assumption, and then there is some assured determination based on that assumption, based on which finally the company decides to go into insurance. So that's one most popular, I would say, way of risk transfer. We will look at the others shortly. The second one is hedge, and hedge in principle is similar to insurance. That for a certain premium that you're paying, for a certain fee that you're paying, you are securing your commodity risk, or you're securing the volatility in your foreign exchange risk. Typically, hedges as a term is used for both financial risk exposures as well as country risk exposures or political risk exposures, where you have business being carried out in very risky economies, and let's say there is a possibility of securing something called as a political risk insurance. This was something that was very prominently available about 5 years ago. I think today the interest to provide political risk insurance has reduced dramatically because of so many things that are happening. At one point in time, it was possible, say, to get insurance for business done, let's say, in Ukraine, right? Today, nobody is going to get you insurance. But there was a situation some time back where risk insurance was available for a country like Ukraine, which meant that in case you want to do business, for the right reasons, right, in Ukraine, and your money for some reason gets lost, your customer is unable to pay you, you can get political risk insurance, right? So that's something that is also available. Not sure where this is now freely available, but typically you would have this option available to you through a couple of international agencies, including the World Bank, including an agency called MIGA, which is Multilateral Investment Guarantee Agency, right? So these are all offshoots of the World Bank and IBRD, etc. So they would be in a position to, insure you in case that is of need. Over to the other one, which is popularly followed, is what we call as ring fencing. And ring fencing, while that term can be legal ring fencing, here I'm using it primarily for financial ring fencing. So all of us are aware in very large infrastructure projects. Say, for example, in Hyderabad we have the Hyderabad Metro. Now the metro is supposed to be, a JV between, say, the L&T and say the local government, say for example, right? Or a couple of other parties come together to form the Hyderabad Metro. Now, you don't want the risks that are, faced by this specific project to flow back to the parent company. You don't want that scenario, right? Those risks can be losses, the risk can be legal liabilities, the risk can be any other element that can financially drain, let us say, the resources of the company, right? So many times, most of the times, in fact, projects that are started, they're all started as JVs or sometimes subsidiary companies, but largely JV models, where the component of the risk that is assumed is directly proportional to the amount of equity put in or the debt that is taken there, right? And nothing more. So this is definitely an option that a lot of companies today undertake for very high risk projects, right? So let's say if an IT company, for example, is heavily investing in AI, and that IT company wants to invest in this without knowing whether the benefits are really going to kick in or not. then there's a high chance that you may want to do this through a JV to make sure that the risks are restricted to the JV and doesn't flow back to your company. So that could be another example beyond the traditional EPC company projects which are taken. The penultimate one is what we normally understand as operational transfers. Now, operational transfers happen all the time. Operational transfers happen for efficiency purposes. Uh, operation transfers happen for aligning the core competencies with the core risks, right, of the processes, etc. The classic thing that has been happening for the last, I would say, decade or 2 decades is IT outsourcing, right? So IT infrastructure outsourcing, IT security outsourcing, a lot of the work that is needed to manage IT, for example. Now, all of this, it's quite possible that the existing companies may not have the competencies or may not be able to build those competencies. And that lack of competency can create its own risks. And therefore, outsourcing happens to be a very natural way, while it's not technically treated as a de-risking strategy, but it often has a significant component of the decision making is linked to de-risking. The same thing happens with KPOs and BPOs that are set up, where accounting teams are basically spun off into KPOs and BPOs. Because the idea here is really that the organization needs to be able to build its ability to run those processes extremely competently and should be able to provide, let's say, a career path to all of those people who are in those transaction processes also. Now, it's practically impossible for one individual company to be able to do it for all of them. And therefore, these kind of outsourcings to very niche outsourcing firms automatically help you manage, several of these challenges which otherwise you would have. So subcontracting is also carried out to manage people-related risks. Obviously, if you are not the legal owner of the people who are on your site. It started with housekeeping, it moves to contracting. In very large organizations, it could be the entire subcontracting of, again, EPC companies, the example that I put there, for example, right? So all of these, basically having an asset-light model ensures lower ownership risks. And that also applies to staff and people, right? So from a legal standpoint, operational transfer can be a great source of this transfer, right? So that's an option. And finally, last but definitely the most relevant for today, Ramanji, is the transfer or cost sharing or any other way of allocation of risks through legal contracts, right? And these legal contractual terms, they could often be called as indemnities, but essentially they are, clauses that are set aside specifically to confirm or to deny the fact that a particular risk that, this particular business deal or this contract or this project may be exposed to, it may or may not be my responsibility as one of the partnering organizations. Now, you do have examples. You have liquidated damages, say, for example. So that's one way to say if my project gets impacted, then obviously we're going to charge you for that. And that liquidated damage could be an ad hoc amount that is expected, kind of calculated, or it could be linked to some form of, loss that the company may, incur. Many times we have in consulting contracts and in IT contracts, you must have seen, where the terms say that unlimited damages, say for example, for certain kinds of failures, right? Not all kinds of failures, but certain kinds of failures where the company may not be, might not have carried out their SLA in the normal course. There may be gross violations, there may be misconduct. So some of those very strong adjectives are used in as a prefix to these failure conditions. But essentially, if those happen, then you could again end up facing limited or unlimited consequences or damage, right? Typically in engineering industries, you have price increase clauses, right? You have price transfer clauses. So if I'm, a steel-based industry, say auto components, for example, or engineering components, for example, then I definitely know that my primary cost is determined by, say, the metal prices which are controlled, and we really don't control those prices. So I may have hedge as an additional benefit, but I may also agree to, pass on some of this to my customers. And you have price increase, or it could be the other way around also, right? Even a price decrease in case the price falls down. But there is no impact to our organization as a participant. And the last clause, which is very interesting, a clause that is going to be the crux of today and connecting back to all of this, is the force majeure clause. And Daman, just one more click, and then maybe I can just summarize my view of this majeure and hand it over to you. So essentially, force majeure clause can be a very powerful way to again protect yourself, especially against risk events that may or may not be insurable, but in any case are out of your control. And over a period of time, my understanding is that this force majeure clause has built a certain set of variables or certain considerations which have got added over time. For some time we just had the acts of God. Later on, we started having pandemics. We've started consciously including war and other elements, more specifically. And this continues. This will probably continue to go on further and further. So it's a very interesting piece, very, very standard. Sometimes, they use the word boilerplate, clauses, which basically means that you can't find any contract where this force majeure is not covered. It's a standard expectation, but it can have significant ramifications, or it can be a great opportunity for you to think about your risks and see how you want to cover it. And this could vary from industry to industry. So that's the area that we are picking up today. Daman is picking up today. But I just hope that this couple of slides kind of has eased you into how opportunities are available from the way we may want to respond to risks, to all the way up to, let's say, using specific clauses in a contract to say protect yourselves, right? Any questions? I'm happy to take. Otherwise, just passing it over to.
Thank you very much, Anand. I request please note down the questions for sure so that you do not miss to ask, you do not forget. Anand mentioned God, and for long, force majeure clause was linked with act of God. That's all that we would understand. And I'll say, yes, God should not be forgotten, must not be forgotten. We must always remember the God. Over a period, what has happened, as Anand was saying, that we have started adding, we have kept adding more to this. And today, if you go deep, we may find that every risk is included in force majeure also, or every disaster is included or covered by the force majeure clause. It's a standard one, boilerplate, as Anand said, but most of us perhaps never looked into it. We never read it. We never understood this. And on top of that, today, attempt is to link this with business continuity management implementation also. So I picked up this definition from Wikipedia. What is force majeure or force majeure clause? It says, from a French word, common clause in contracts which essentially frees both parties from liability or obligation when an extraordinary event or circumstance beyond the control of the parties, such as war, that's what I was saying, almost everything is covered. Now, God doesn't make war. We used to call force majeure clauses act of God. We, the people, make the wars, but even war is most likely covered. Strike, riot, crime, epidemic or pandemic, or sudden legal changes prevents one or both parties from fulfilling their obligations under the contract. Explicitly excluded is any event described as an act of God. Now, this definition is saying act of God perhaps is excluded. But hold on, please. This is just one that I picked up from Wikipedia, which covers a separate domain and legally differs, yet it is still related to contract law. In practice, most force majeure clauses do not excuse a party's non-performance entirely, but only suspend it for the duration of the force majeure. So it seems there has to be some duration linked with this clause. My request is we go back to our companies and we look into the force majeure clause. It should be as a boilerplate. If you find that it is not, then it is more risky situation for us that in different contracts, we have written the force majeure clause differently. My understanding, this is what this clause is saying. If you are my customer, I am your vendor or supplier, service provider. With folded hands, I am saying, dear customer, please do not penalize me if I fail to deliver to you due to act of God or due to something which is beyond my control. And sometimes we'll go into the definition wording. It may say beyond my reasonable control. In a contract, there are many exit clauses or termination clauses. One is by period. This contract is for 1 year. So after 1 year, it is terminated automatically. Second is both parties can give a notice, a week notice or a month notice or few months notice to each other and can terminate this clause. Third may be linked with performance. Due to non-performance, the client may like to say, we are terminating this. And again, there may be a notice required there perhaps. The fourth is this force majeure also is a termination clause, which perhaps you wouldn't have understood. So I'm taking a live case, live example without naming the company. This is how they have written their force majeure clause. Neither party will be liable for any failure or delay in performing an obligation under this agreement that is due to any of the following causes to the extent beyond its reasonable control. See, that was the definition, but this is a real clause from a real contract. Acts of God, accident, riots, war, terrorist act, epidemic, pandemic, including COVID-19 pandemic, quarantine, civil commotion, breakdown of communication facilities, breakdown of web host, breakdown of internet service provider, natural catastrophes, governmental acts or omissions, changes in laws or regulations, national strikes, fire explosion, generalized lack of availability of raw material or energy, and the source in front of you. What we notice is there is no duration mentioned here. While based on Wikipedia definition, I had said there must be a duration, it seems to us, by the definition. So for that reason, I'll go to the next example, which once again is a live clause from a live contract. Little longer, so I'll not read it all. Most is similar, same, but look at the bottom, please, which is highlighted, bold. Either party will have the right to terminate its agreement or this agreement if a force majeure event that will or continues to prevent performance in whole or substantial part of this agreement for a period of at least 90 days. Can we go, shall we go deep into the wording at least? Should it be at the most? I'm not sure as of now, but I'm still picking up this. It seems what we are saying is, this is my interpretation, that both the party, you, my customer, and I'm the service provider, are agreeing This clause is part of the contract, which is signed by both, that if my first request is, please do not penalize me because something beyond my control has happened. But at the same time, also, I'm saying, and you're agreeing, that if I'm not able to recover from this situation in 90 days, you have the right to say no to me, terminate this contract, go to someone else. And this is two ways. Source major can happen at your end also. So you're also saying, if this condition continues for more than 90 days, we both have the right to say no to each other. This is also an exit clause or a termination clause. With this duration, 90 days, it's one example. 90 is a rare that I have seen, perhaps only two companies, I would say, or two contracts, I would say. Mostly it is 28 days, 4 weeks, 30 days, or 1 month that I have noticed. So I'm repeating, force majeure clause, very important. It's part of risk management. Anand said, I'm going to link this with business continuity management. In nutshell, simple language, this is what I'm saying. Please do not penalize me if I fail to deliver to you. You are my customer, I'm the service provider. At the same time, we both are agreeing that if this decision with me continues for beyond this period, whatever has been mentioned in our clause in our contract, then you have the right to go to someone else. And force majeure clause, according to me, is two ways. Anand also said exploit. Time permitting, I would like to come back to him and discuss a little more around that exploiting a risk. I use this term. It appears to be negative, exploiting someone. I tend to use this positively, and that's what I'm using here. Force majeure clause and its terms to be exploited for our business continuity management implementation. We know some rules, some definitions, some principles of business continuity management implementation, that RTO, the recovery time objective, must be less than MAO or MTPD, maximum acceptable outage, or maximum tolerable period of disturbance. There are official definition available, or there are official definitions available. We can go into ISO standards or any other established books. What is RTO, recovery time objective, recovery point objective, maximum acceptable outage, MTPD, etc. My simple way is I say MAO is when things go beyond control for you, or when you're not able to bear the losses anymore, or when the impact becomes unacceptable to you. The situation due to a disaster, when you have gone down, this becomes unacceptable to you. The period, the unit of MAO is time. Starting from seconds, it can go to years or whatever, but it's time. So this is what is the limit from force majeure clause. This is what I'm picking up, that 30 days, 28 days, 4 weeks, 1 month, or in a case taken 90 days. We are agreeing that that's what my limit. If I do not recover from any disaster in 90 days, then it's beyond my control. I'm out of business. I do not want to see that day. Based on that, the relationship between RTO and MAO, that RTO must be less than MAO. If you pick up 90 days is my MAO, 0 or 1 day is less than 90, and 89 is less than 90. That's what my RTO is, the one. That's not reasonable and practicable. 89 is too bad. I'm also almost dead. I'm almost out of business. Even if you start recovery now, the chances of survival are very, very low. So that's not good risk management. A 0 or 1 is too good. In BCM terms, it's too costly. to have such arrangements. Zero RTO, one RTO, 1 day RTO, or shorter RTOs. So roughly, I always say it's 50% of MAO, which is your RTO. So with this discussion, base was 90 days in one of the force majeure clauses. I go to this slide. You would have selected, or you need to select the categories of impact when you're conducting business impact analysis. So whatever you select in your organization, I'm just showing to financially or reputationally. BIA also is impact over time. So you need to find this timeline, and this is where we pick up 90 days from force majeure clause. If it's just 30 days in your force majeure clause, then you will take 30 days to be your outer limit. That's your MAO and TPD, which means you should recover in roughly half of that. 45 is your worst RTO, which means the longest RTO, longest time window available to you to recover any process based on what we have, the data we have in front of us is 45 days. And the best is in the given, once again, in the given scale, if you were starting from 1 hour, then half of that, about 30 minutes, half an hour is your best RTO. How many of these columns should you have? There is no rule about that. You need to think about your business yourself. Practically 4, 5, 6 columns are enough. Within that, you may like to start with 0 seconds or 30 minutes. And then from 1 hour, as shown here, you may like to go to half a day, 3, 4 hours, 1 day to 7 days. You may say, no, we'll add 3 days also. It's all up to you. Why don't we have 45 days here after 30 days? There is no rule around this. This is just one example that I have shown. But I'm attempting to link this back to the force majeure clause, the duration that you would have received or got from there. So in the given example, once again, I'm saying, if you see the last column, 90 days, the outer limit, we are picking up from the force majeure clause. RTO must be half of that, not must be. Good practices to have half of it. So in these MAOs, 1 hour to 90 days, keep doing 50%. Those are the RTOs available. I'm repeating. The best RTO here is half an hour. The worst RTO is 45 days. This also allows us some leeway, cushion. 45 days, I should recover the basic minimum. Then we come to another term called MBCO, minimum business continuity objective. Assume we wanted to recover 20%. So I have 45 days to recover 20%. But to go out of the business, there are 45 more days available to me. So now these 45 days, I can keep increasing if possible. I can keep increasing my productivity or level of service from 20% to 30, 40, 50, if possible to 100% also. This is where I would like to stop on linking force majeure clause with business continuity management implementation. Within that, with BIA, business impact analysis. Within that, the MAO MTPD period, through which we then estimate the RTOs. This is our weekly show, 8-part series. Today, the second one. The next one is next Wednesday, once again, 1:30 p.m. IST. Anand will be taking a lot of lead in that. AI implications on organizations' risk and resilience decisions. And going up to the last one, we have already found or decided the topics to be covered for you. With this, I would like to thank you all once again, but we have time for questions. If you have questions, I'll switch off the sharing slide. Please switch on the cameras. Please unmute yourself and feel free to ask any questions. I'll wait for a few seconds, and if not, then I have some questions for you. Krishnan wants to ask a question. Go ahead, please.
No, no questions as such, sir. But of course, I think there's a big legal aspect as far as force majeure interpretation is concerned, right? Because of course, it is all linked to the contract language. So what a vendor thinks is force majeure, the customer may not accept. Something like that. I'm just putting thoughts out there.
Yeah.
Because now, of course, I'm in Bangalore. There's a major water crisis here, and
Right.
IT companies are saying that when the landlord of the building in which they have leased is contractually bound to provide water, but
Right.
in such cases, the landlord can turn around and say it's a force majeure because I can't do anything about this.
Right.
Yeah.
Correct. Yeah. Thank you very much. So what I'll say, yes, I agree. It's a legal question, point, or consideration. Full contract is all legal, and it's difficult legal language also, which is one of the reasons that people like us do not like to read the contracts or do not even understand if you want to attempt to read. But once it has been signed by you and me, then we are bound with it.
Yeah.
So whatever consideration I had to have, review I had to have, or interactions or refinements I wanted to have, should have happened with you before signing it.
Right.
After that, it is binding upon both of you.
It is binding.
Right.
Yes.
I agree. Thank you very
Absolutely.
much. Thank you very much. And then to utilize the time available with us for the benefit of our audience, all of us, mostly generally, all organizations, after the performance appraisals happen, the output is PDP, Personal Development Plan, based on no one is perfect. So I have some weaknesses which need to be fixed upon, improved upon. So my boss writes a PDP for me because I have some weaknesses. My wish list is, I have been saying, this is how I've been using exploit word, that everyone has some sense also. So rather than focusing to bridge the gap on weaknesses, let's exploit his or her strengths to the best of the company for the best utilization of the company. You said exploiting a risk. Can you give an example, please? Elaborate upon this. How do we exploit a risk?
So the example that I had stated even earlier, Daman, I just want to use that again. So essentially, there are certain areas where it is generally considered to be risky, right? Like, for example, patent infringement. Now, if you are a software company, you're a pharma company, you're a product-based company, one of the key concerns that you will have as a creator of, say, IP is the fear that you may be infringing on someone else's IP,
Right.
so that the moment you end up launching your product, you are actually causing harm to the potential, infringee, if I can use that word, or the innovator, and you can get sued, right? So essentially, this is a risk that a lot of people consciously avoid. That you don't want to get into a situation where there is IP infringement because of the work or the product you're developing or you're selling. But now here is a situation where IP infringement becomes a legally available route for you, provided you're doing it the right way and provided that it is a competitive strength to you, right? And that is the model that a lot of these companies in pharma called the generic companies actually adopt. And I come from one such generic company myself, and I understand how this, this whole strength or competency is exploited.
Right.
Now, if you were a averse company, you would not venture onto developing any product where you might believe that you are going to be potentially into some infringing mode, right?
Right.
As against that, you are definitely going to be, you are extremely confident that you can design and develop a product which is a non-infringing product, right? Or develop a process which is non-infringing. And that is something that you can definitely do, provided it is It is a core competence that you develop, right?
Right.
So
Right.
for most companies, this is not a risk that they would take. For certain companies, this is a risk that they would take and succeed.
Right.
So those are areas where we normally call competence, right? Now, this can be for a specific topic of risk, like in this case, IP infringement. It could be for a specific industry. At an industry level, you find that there are certain industries which are intrinsically very risky. Take, for example, construction industries, right? Now, given a choice, and if you have the option to open any industry, you would not go and select a construction industry. Construction industry works with very very thin margins. अगर कोई भी operational risk आपका project पे लग गया, so it can have a direct bearing on your overall company profitability, and they work with wafer thin margins, 5%, 2%. I've never seen a construction industry's profit cross more than 8%, PAT, right, or PBT. And this is really very, very, powerful, that if a company is actually able to not just play, but also thrive in such industries, then
Right.
clearly that is a sense of competitive advantage. Now, I mean, exploit risks in this way, and it is also meant to be said positive, right? You can't, usually there are downsides. Risk is always a downside. And I believe that there are downsides to risks, but
Mhm.
there could be very, very few risk areas like this, which if it is handled through a core competency that you can manage, then, you actually exploit it. I'll give you one example, which is very popular, and I think a lot of people might probably relate to it. So we know DuPont, for example, as a company is extremely well known for managing safety risks very well.
Right.
So one point in time, my understanding was DuPont doesn't insure its safety risk, right, up to $1 billion,
Okay.
right? Matlab, up to $1 billion, they are extremely confident
Solid.
that their risk management practices will not
Take
put them
care.
into trouble,
Right.
or their risks are well within the tolerance or the appetite level that they've set.
Right.
But they have still kept some, extra contingency elements which may be beyond their control, and they say that that limit of 1 billion or more is something that they may want to cover. So these are some very, useful ways to understand that a topic that generally you may want to avoid or transfer is something that you take and exploit, right? So that's where I meant.
Right. Great. Thank you very much. Looking at the time, I would like to pick up your mind quickly, quick ones, two, which appear to be very interesting to me. Deliberately assumed a risk is generally not insurable or is not insured.
Right.
There is a concept, my understanding, that suicides are not covered in life insurance. Or if a person commits suicide after buying life insurance, that perhaps is not paid to the family. Is it a right connection with this deliberately assumed risk?
Not really, because I think the concept of life insurance is very different from business risks, right? In the sense that these are commercial in nature. It's for the purpose of, I mean, the principles may still be the same of insurance, but I think the context changes entirely. When it is a business, then very clearly you have a set of ways in which you may choose to take risks or deal with risks, right? But there are certain elements, like the examples that I gave. For example, it is very difficult to get traditional insurance. You can get insurance for some of these in the alternate insurance market. So they call alternate risk transfer markets, like the captives that I talked, where even deliberate risks can be productized, can a premium can be assigned to that. And while it
I'm
follows
planning to
all the
fail.
principles of,
I'm creating a company to fail.
I am not creating a company to fail, but I'm taking, uh, I'm trying to insure a risk for which there are no markets available, because such kind of risks are not insurable in general. because you're willingly taking those risks. I'm not saying I'm planning to fail. I'm saying I'm willingly taking risks,
Okay.
right? And those are different. That's all. That is the only difference. I may not have a direct answer to your question because I'm not very sure if uh, there may be some insurance products where suicides are covered. I do not know.
Okay.
But maybe health insurance products have something there for mental health, etc. But I'm not really very sure right now, so
Okay.
unable to answer that.
Okay. I guess still an extension of a similar concept, especially in last 3 years during and after COVID-19 pandemic, when work from home has become long ago, even big corporates in the world had said is a new norm.
Right.
While it's
Right.
changing and almost all companies are admitting coming back to offices better. Assume a person is working from home. Home is the extension of the office, just like the extension branch of a bank.
Right.
So all the rules and regulations and policies applicable in office become applicable at home also. And we may not
They
pass,
do.
fail
They do.
automatically, or does this need to? I'm bringing this to something
No, but
very
along,
important.
no, very important point. So
If not
along
in
with
all
the,
companies, if not in all companies, but in some companies, or perhaps it used to be in all companies, it still exists in some companies, like manufacturing, where there is more possibility of health hazards, concept called death on work, which
correct,
means if someone would die while working in the office, while on work, there would be some extra compensation available to his family or her family, which
right,
most likely was covered through an insurance. Now the
right.
same person is working at home from home and dies. Will
Right.
that compensation be available? Is this applicable automatically, or do we need to have specific arrangements? We need to talk to the insurance companies.
I think it is again about how the fine print is written. Normally, what happens is for non, let us break this into two components. Let's just say now we are not talking about risks which are associated with life of a person or an employee or an associate,
Hmm?
but all other business risks. Let's say, for example, my colleague is working from home and let's a cybersecurity incident which happens because of controls may not be as strong as they are supposed to be at
Right,
office, right?
right.
And the company happens to lose or the company is sued or whatever happens. Now the question
Same
to
thing.
ask is, will
Yes,
cybersecurity insurance pay it? That is an easier question to answer. And there I would assume that what the fine print of the contract you've signed would directly address that. My sense is that work from home for a lot of industries has always been there, and it has been there for quite some time, not just now. I mean, work
yeah,
from home en masse has happened now, but
right,
otherwise it has always been there in smaller big ways for quite
right,
some time. So
right.
I'm sure that the current age insurance clauses would have covered it. While I've been out of insurance for the last few years, so I'm not able to understand how the wordings today are going to be. But
Understood.
one thing is for sure that the fine print has two components: what is covered or who is covered, and also what are the prerequisites for the company to enjoy getting that insurance. So the insurance protocols also expect you to have certain controls in place. Now,
Yeah,
let's say if your employee worked from home and those controls were absent, but it is promised that those controls would be in place,
yes,
then there is a possibility that the insurance may be denied. That is my personal view.
right,
And therefore, what fine print goes both ways, right? Fine print goes in terms of what is covered, which means is my employee's home covered as in principle, right? And the other is, are the conditions which allowed me to enjoy a certain coverage, whether those conditions are violated, right?
right.
And therefore, will I be eligible for this? So I think it works both ways. So the fine prints will probably answer,
Yeah,
but in general, I would assume yes for all of
great,
this.
great. Thank you very much. Exactly at an hour, and I would like to conclude by saying, based on these discussions, that risk and resilience, to be effective, we must understand our contracts that we have written, the fine prints, whether it is insurance policy or any other
Right.
contract, any other agreement that we have written, including force majeure clause, which we were discussing today. Very important portion. Insurance we discussed today. Next week, same time, 1:30 p.m. IST. Before we log off, thank you very much to all of you. I want to take a picture also. Krishnan, are you okay to switch on the camera?
Of course.
Great. Let me attempt. And this is how. Give me the best smiles, please. Once again, for everyone, thank you very much, and see you next Wednesday at 1:30 p.m. IST. The yin and yang of risk and resilience with Anand and with me, Daman Dev Sood, your host. Thanks. Bye-bye. Have a great day.